Good afternoon. Happy Friday, June 20th. Mark Milam here, your mortgage professional. If anyone cares, mortgage interest rates were relatively flat this week, maybe improving a little bit towards the end of the week. But really, what was caught all the headlines this week is the back and forth between the economic news and the political news. These two seem to be very closely related to each other. As the Fed met this week on Wednesday, they did not alter the Fed funds rate, much to the president's chagrin. They also did not hike the Fed funds rate. They didn't lower or hike. They left it steady, pointing out to the future to say, hey, listen, there are some leading indicators that say inflation could see a resurgence. Perhaps there's some impact from the tariffs that have yet to come. In fact, Powell made a note of that in the 2 p.m. conference on Wednesday, or 2:30 p.m. conference on Wednesday, to state, hey, someone's got to pay these increased prices, whether it's businesses or ultimately consumers. Sooner or later, someone has to pay for this. We think we can take a wait and see approach. In fact, if you take a look at some of the comments here posted on CNBC, the Fed actually says the Fed is well positioned to wait. And that is a message that we have heard from Fed Chair Powell over and over again. We're going to take a wait and see approach as it pertains to the Fed funds rate. If you scroll down the screen, and I'm going to take you all the way down here, don't get dizzy on me, to some investment banks, they're talking about the fact that, hey, we're moving towards a no rate cut environment. This is from Morgan Stanley's chief investment officer. Keep on going down the screen. JP Morgan says, don't hold your breath for lower rates from the Fed. Right? This is all kind of what we could come to expect from Fed Chair Powell until we start to see the labor market break, until we start to see unemployment rise substantially, or inflation be sub 2%. Don't expect the Fed to cut. They're just not of a mindset to do that when there's still a chance that resilient labor market could reignite inflation, or tariffs could reignite inflation. But we have a holiday yesterday for Juneteenth, and then today we get comments from another Fed member. This is Christopher Waller, Fed Governor Christopher Waller, who says the central bank could cut rates as early as July. What? we have two competing narratives here. We've got what Fed Chair Powell said on Wednesday, which is, listen, we're in no position or no mood to begin rate cuts. We're going to take a wait and see approach. And then 48 hours later, one of which was a holiday, we have a Fed governor stating that they're in a position to cut as early as July, next month, just a couple of weeks from now, right? So two very competing narratives. And we all know Fed Chair Powell's tenure as Fed Chair is up early next year. Could Christopher Waller be positioning himself for a favorable appointment from a president who definitely wants to cut? Let's move to that story. So here's the president's most recent post on Truth Social about Jerome Powell. He loves his nicknames. Too late, Jerome Powell is costing our country hundreds of billions of dollars. Truly one of the dumbest and most destructive people in government. This is the president of the United States talking about the Fed chairman that he appointed. And the Fed board is complicit, so says the president. Europe's had 10 rate cuts. We've had none. We should be 2.5 points lower on the Fed funds rate. That means the Fed funds rate would be what? Down somewhere around 3%. That would save billions on all of the former President Biden's short-term debt. We have low inflation. Too late is an American disgrace. Not to be outdone, the Federal Housing Finance Agency Director, Bill Pulte, is now calling on the Federal Reserve Chairman to resign. So let's go back and cover this real quick. So the Federal Housing Finance Agency is the overseer or the parent of Fannie Mae and Freddie Mac. They set forth all kinds of policies, pricing restrictions, pricing adjustments for Fannie Mae and Freddie Mac. And the director who's in charge of the Federal Housing Finance Agency is Bill Pulte. So Bill Pulte is now calling on the resignation of the Federal Reserve Chairman, Jerome Powell. And I'm going to show you a couple of his posts here because he's had a lot of them. In fact, if you go back here and look through his X account, or formerly Twitter account, since Wednesday, Pulte has had over 25 posts about the Federal Reserve Chairman. And I'm going to call out this one in particular. He says, quote, "It is so totally reckless to keep rates where they are at." This is the director of the Federal Housing Finance Agency. "Mortgage rates were 3% and went to 7%. This is crazy. This crushed affordability. Inflation is down. Mortgage rates and interest rates need to come down. Jerome Powell is doing a great injustice to this country." And you can see here, Grok, the fact checker, the AI fact checker for X, says, what happens when interest rates are lowered too soon? Lowering interest rates too soon can fuel inflation, currently at 2.4%. by boosting spending and prices. It risks asset bubbles like in housing. And I'm going to go on to say this. When the Fed board lowered the Fed funds rate back in September, what happened to the 30-year fixed, right? It took off. It went north. This is a policy-driven rate down here at the bottom. This is a market-driven rate up at the top. When the Fed began lowering the red line, the Fed funds rate, and began cutting interest rates, the 30-year fix took off and went north. Why did that happen back in September? Well, because the 30-year fix is a market-driven rate. And the perception in the market was the Fed was cutting too much and too soon, not sure that inflation is fully back in the bottle yet, and the market responded accordingly and home ownership affordability worsened. So we can't just say that it's a linear choice, right? That if the Fed began cutting the Fed funds rate, that mortgage rates would respond in kind. In fact, those are two very different rates. The Fed funds rate is an overnight lending rate to banks and financial institutions. The 30-year fix is just that. It's a 30-year loan. And sometimes they move in the same direction, but sometimes, just as I showed you, they move in totally opposite directions because they're influenced by different things. And while we're on the topic of making home ownership more affordable, one of the things that could be done immediately, overnight, is that the director of the Federal Housing Finance Agency, Bill Pulte, could call for a suspension or a reduction in loan level price adjustments handed down to Fannie Mae and Freddie Mac. Listen, if you've gotten a mortgage in the United States since 2010, 2009, you've paid some level of these price adjustments, these pricing penalties. You've paid some level of them to have a mortgage. If we reduced or removed these loan level price adjustments, home ownership affordability would improve overnight. Yet the director, for some reason, now seems to just be calling for the resignation of the chairman of the Federal Reserve Board. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.